With markets experiencing some turbulent times and with a possible recession on the horizon, you may be looking for ways to safely invest your money. While we can never guarantee outcomes, we can tell you what we believe are the best steps to take to navigate these turbulent times. For starters, we believe owning dominant businesses with pricing power and investing in companies that have strong balance sheets can help companies determine their own destinies and build wealth for you as a shareholder. Dominant businesses with pricing power can generally dictate the terms of their products or services, allowing them to charge premium prices and generate higher profit margins. This gives them a competitive advantage in the market and the ability to invest in research and development, expand their businesses, or make strategic acquisitions. Having a strong balance sheet is equally important. It can enable companies to weather economic downturns and invest in growth opportunities. A strong balance sheet can also provide companies with flexibility, allowing them to pursue opportunities that may not be available to their competitors. We believe that when a company has both a dominant market position and a strong balance sheet, they are in a better position to determine their own destiny. They can make strategic decisions based on their long-term goals rather than short-term financial constraints. As we look back over the last year and a half, investors have experienced some difficult losses, but it's important to remember that in our opinion, these are not permanent losses of capital, at least not all of them. Investing in the stock market carries with it inherent risk, but if you remain consistent and vigilant with a proven strategy, your time in the market can pay off far better than trying to time the market. It's also imperative that we adjust and manage our expectations for future returns. We believe it's prudent to prepare for a more historically normal cadence of bear markets. This chart shows 65 years of investing history, which we believe is a reasonable enough approximation of an investing lifetime. Of course, future returns and volatility could turn out to be better or worse than the past, but we think a sensible investor's base case should include at least as many down periods as we've historically experienced. Therefore, we should all reasonably expect to experience roughly 12 periods of greater than 20% peak-to-trough losses, 6 periods of greater than 33% losses, and 3 periods of approximately 50% losses during our lifetime. As draconian as that may sound, another thing to remember about bear markets is that they have historically been relatively brief compared to the much longer bull market periods. As you can see, bull markets have typically been many multiples longer in duration than bear markets, and their price gains have usually more than made up for any losses experienced during bear market periods. Of course, in the moment, bear markets feel endlessly long. But this graph reminds us that our current bear market will end, and that if history is any guide, the bull market that emerges is likely to be much longer in duration and much more powerful in scope. The graph also reminds us that equity investing has, over the long term, grown investors' wealth, and that this volatility in financial markets is the price we all must pay for the enormous excess returns that long-term stock investing has historically provided over government bonds and treasury bills. The party of 0% interest rates is definitely over and has caused speculative assets to roll over, including a slowdown in real estate transactions. YCG doesn't take a position on predicting the Fed's decision on interest rates. We believe it is much more important to identify quality businesses with network effects that have enduring pricing power exhibited in many cases through high sustainable gross margins. While many investors and the market focus on the short-term whipsaws of current trends, we remain vigilant and patient in the adaptability and overwhelming dominance of our businesses to continue to generate excess returns for shareholders. It's essential to keep in mind that the market can be unpredictable and short-term market movements can be challenging to predict. Trying to time the market or make investment decisions based on short-term trends can lead to significant losses for investors. At YCG, we believe in taking a long-term investment approach, focusing on identifying high-quality businesses with sustainable competitive advantages. We believe these businesses have the ability to generate excess returns for shareholders over the long run, regardless of short-term market movements. We encourage our viewers to adopt a similar mindset and to invest in high-quality businesses with enduring pricing power with network effects. By taking a patient and a disciplined approach to investing, we believe investors can achieve long-term financial success and avoiding pitfalls of short-term thinking. Thanks for watching, and we hope you found this video informative. Don't forget to subscribe to our channel for more financial insights and investment strategies. All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.